Hey everybody, Smart Silver Stacker here. It's Wednesday, May 18th, 2022, and we are seeing a lot of pain in the markets today. Big sell-offs across the board. And one of the major catalysts for the sell-off today was Target's earning report, which was a big miss. And it's demonstrating that inflationary forces are eating into the profit margins of retailers like Target. And you can see the price of Target shares plunging today, down more than 27% following that disappointing earnings report. And it's not just Target, so it's not isolated to them as a business. Walmart also had terrible earnings report on Tuesday. And you can see here on this 5-day chart that they gapped down in a big way at the open yesterday, and the sell-off in Walmart shares continuing today. The stock down to $122, and on Monday it was trading for above $148. So that's a huge sell-off in a giant retail company like Walmart. And one of the ironies of this whole thing is that, politicians, they like to point their fingers at businesses as a scapegoat when prices start to move up, saying that businesses are just being greedy and they're just charging, whatever the market will bear. But clearly, this is an indication that actually the opposite is true, and that companies like Target are trying to keep their prices low and not pass on the increased cost of inputs to their customers, because businesses don't like to raise prices. When you raise prices, it means you sell less stuff, and businesses don't like selling less stuff. But think about Target. Think about how their inventories get to their stores. Everything arrives on trucks. And what do trucks run on? Trucks run on diesel fuel. And you've seen what's going on with the price of diesel. Diesel is up astronomically. And so Target, they're paying a lot more to stock their stores. And obviously they have not passed all of those costs on to consumers. That's why their profit margins are eroding. But ultimately they're going to be forced to. And when that happens, the consumer is really going to get squeezed. And all of this is an indication that the economy is moving closer to a recession. And we're seeing that as the pain is not relegated to the retail sector. We're seeing just a sell-off in assets across the board today. The S&P 500, the Dow, the NASDAQ, the Russell 2000, crude oil, gold, silver, Bitcoin, everything is selling off today. And the most seriously affected sector is probably the most speculative, the NASDAQ. But like I said, all of the major stock indexes down more than 3% today. So a lot of pain across the board. And I want to take a look at just how far some of these assets have fallen, because I think the numbers are kind of surprising possibly, and also interesting. Let's take a look at the 1-year chart for the S&P 500, for example. And I'll pull up my little handy dandy calculator here. And we can see that back in December, and this is a weekly chart, so these are the high weekly prices. It doesn't necessarily reflect the intraday highs or the daily closings, but it's good enough. Looking at a weekly chart kind of filters out the noise. We can see that the high was 47.66, so we're down to a level of 39.40, and that represents a decline of about 17%, a little over 17% from the highs. So certainly a big drop in stocks. Now, if we look at the NASDAQ, we're going to see something a little bit different. We go back to November to get the high for that at 1657. And then today we are at 11,424. So fallen a bit more in the NASDAQ than in the S&P. And you can see that that reflects about a 28% decline, actually closer to 29% from the highs. So more pain in the NASDAQ. And then crude oil, that's an interesting chart there, because we look at the 1-year chart for that. Crude oil really hasn't fallen that much from the highs. The recent high was in February, just immediately following the Russian invasion of Ukraine. And although we have seen the price pull back a little bit from there, it's recently risen back up to very close to that high, almost over $110. Yesterday we were above 110, small sell-off today, but you can see crude oil has not gotten nearly as beat up as stocks. In fact, it is trading very close to its all-time high. So I'm not going to even run the numbers for that one, but that's just interesting to note. I expect energy will probably continue to march much higher, buoyed by the forces of inflation and also by the geopolitical conflict over in Europe. Now, silver has absolutely gotten quite beat up. We go back to June to get the high from last year of 28.13, and we've fallen down to the 21.45 level, and that's actually we were under $21 just in the past couple trading sessions. So silver has recovered a little bit, but it's down again today. And just to see how much we've fallen from the highs of last year, can see that's a 23, almost 24% decline. So somewhere between the S&P 500 and the NASDAQ. The NASDAQ has fallen a bit more than silver, but the S&P 500 has fallen less. So that is interesting. But then they do also want to take a look at gold. And this is really the most interesting to me of all of these numbers. You can see back in March, we hit the recent high of gold, and it actually was above 2,000, I believe, intraday or on a daily close. But again, this is a weekly chart, so we'll go with the weekly closing price since that's what we've been using for everything else, of 1,982. And today we are at 1816. So you look at that and you realize gold only down about 8.3%. So gold is doing exactly what you would want it to do, exactly what you would expect it to do. It is a store of value. Of all the assets we're looking at, it's been the one that has fluctuated the least, and that is exactly what gold is supposed to do. You know, gold is real money. I would rather hold gold as a store of value personally than cash, although, you know, in this environment, it is good to have some cash, certainly, because this sell-off could get a lot worse. It's kind of hard to say how much pain the Fed is going to be willing to tolerate before it reverses its policy. They've only raised interest rates by 0.75% so far. And we've seen this much pain, you know, a lot of pain, not so much in gold, but in other assets, pretty much across the board. We're seeing this correction continue. And I'm not sure how much the Fed is going to be willing to tolerate, but you also have to remember they haven't even begun quantitative tightening yet. And when they start that in June, that's going to put even more pressure on these markets, as well as, you know, we've got 5 FOMC meetings remaining this year. According to the Fed, you know, they're getting tough on inflation. So their plan is to raise interest rates, I believe, by at least 50 basis points at the next 2 meetings. Compared to where we're at right now, that's a big move up. You know, if they raise interest rates by 50 basis points at the next 2 meetings, that gets us to 1.75% on the federal funds rate, and that's more than double what it is right now. So, you know, there could be a lot more market pain moving forward, although I do suspect that at a certain point, the Fed is going to just have to capitulate and reverse policy. I don't think that they're willing to see this pain continue too much, because the whole narrative of an economic recovery that we keep hearing, all of it is based on this wealth effect. And pretty soon, we're going to see more and more of that wealth continue to evaporate, and that's not going to be very popular. So I think we're going to start seeing some pressure on the Fed to reverse policy, to be more accommodative. We're not there yet, but I think we might get there soon. And then, you know, one last thing, here's the chart for Bitcoin. Let's look at the 1-year chart. And you can see Bitcoin's high back in November of 65,000, actually 65,466. Put that in compared to today's number, and you can see that Bitcoin is down more than 55% from its high of last year. And, you know, I guess there's 2 ways you could look at that. You could say that Bitcoin was in a tremendous bubble at 65,000, and I think that's the story I kind of tend towards. Or you could say that, you know, Bitcoin is more on sale than any other asset, and it's a great time to be picking up some Bitcoin. I mean, personally, this is not a dip I want to buy. I would consider grabbing some crypto because, you know, I'm not fundamentally opposed to Bitcoin or blockchain technology. I just think it's very richly valued at the moment. If we saw a drop down to, say, under 10,000, which is absolutely possible because, you know, we've already seen it fall 55% from the high. Why we couldn't see it fall considerably further, I don't think there's any compelling argument why it wouldn't. And the weird thing with Bitcoin is, you know, it's kind of hard to say what a fair value is for it because there's nothing to base it on. You know, there's no earnings. It's not a company. It doesn't have a long track record, so there's no long-term ratios to look at. The stuff has only been around for a little over a decade. It's kind of hard to say what would be a fair value for Bitcoin, but the decline that we have seen in Bitcoin, it is the worst performing asset out of all the ones we've seen so far today. And then gold is the least volatile and best performing. I think that this illustrates very nicely that Bitcoin, whatever it is, it's not digital gold. It's not a store of value. It is closer to a risk asset. Volatility is enormous in Bitcoin. So, you know, when you buy it, there is the potential for tremendous gains, but hand in hand with that comes the potential for tremendous losses. And so it doesn't, you know, fit the bill of digital gold or a store of value like a lot of Bitcoin advocates have tried to paint it as. And I think that this price movement illustrates that nicely. So let me know what you think in the comments down below. Are we going to see more pain in the markets? Is the Fed going to have to reverse policy? And what do you think about the decline in Bitcoin? And what do you think about Bitcoin being called digital gold? I'd love to know what you have to say, so let me know in the comments. If you enjoyed this video, please do give it a big thumbs up, and I'll catch you next time. Thank you all very much for watching. Smart Silver Stacker, out.